and welcome to this week's edition of Energy Frontiers. I am Justina Okechukwu. This show has been proudly supported by the African Energy Chamber. Let me walk you through some of the biggest energy news from here in Africa and around the world. A major boost for Namibia after Total Energies announced it has bought an additional 10.5% participating interest in the country's Block 2913B, which contains the Venus discovery, and another 9.39% participating interest in Block 2912 from Impact Oil and Gas Namibia Limited. AIM-listed Tanzanian explorer Helium-1 Global Limited this week announced that it has commenced drilling at the Intumbula West 1 well in the East African country, targeting two major fault zones and the Karoo Play. In Southern Africa, Azule Energy has signed a risk service agreement with Angola's National Agency for Oil, Gas and Biofuels to operate 3 more blocks in partnership with Equinor and Sonangol. Gola LNG Limited says its floating liquefied natural gas unit, Gimi, has arrived at the Greater Tortue Ameyim field, which is located offshore Mauritania and Senegal, and is owned by British Petroleum. Meanwhile, BP has awarded a 3-year multi-million-dollar operations services contract for the GTA project to energy services specialist Petrofac Limited. In North Africa, Dubai-based explorer Dragon Oil recorded a major milestone after it kicked off crude oil production from the Al Wassil field offshore Egypt. This is the company's first oil discovery in Egypt and the largest in the Gulf of Suez in the last 20 years. The African Energy Chamber has affirmed its support for the Invest in African Energy Forum, which is set to take place in Paris on May 14 to 15 this year. Organized by the Energy Capital and Power, the forum will serve as an avenue for engagement between European and African stakeholders on new projects and access opportunities within the African energy landscape. And that was a snapshot of your energy news headlines. The IEA says the world needs more support to triple renewable capacity by the end of this decade. More on this in a moment. Welcome back. The International Energy Agency reports that in 2023, the world's annual renewable capacity additions increased by almost 50% to nearly 510 gigawatts, indicating the fastest growth rate in the past 2 decades. At the launch of the 2023 Renewables report by the IEA, the executive director, Fatih Birol, noted that renewable energy capacity is expected to be 2.5 times higher by 2030. Here is an excerpt.
So when I look at the numbers, it is definitely a wow effect because last year, 2023, we see that the renewable capacity expansion in the entire world, 2023, was over 500 gigawatts. And this means 500 gigawatts, over 500 gigawatts increase means close to 50% increase of capacity additions of renewables compared to 2022. A huge historical jump. It's a very good news, and the big chunk of this growth comes from solar, and followed by wind and other renewable technologies. China is the single most important driver of the spectacular growth 2023 when it comes to renewable energy, both solar but also wind and the others. our analysis show that almost everywhere in the world, the cost of electricity generation from renewables is cheaper than it is alternatives. And in some cases, maybe I should say in many cases, cost of generation of electricity from renewables is even cheaper than existing fossil fuel power generation. Our report finds out that with the existing trajectory, existing policies, global renewable power capacity will increase by a factor of 2.5. It is not yet there, but it is not miles away from that target. As such, it is definitely an encouraging result, and it is something that we need to build on. And if you ask me where we have to put more efforts, the answer is clear. We should be getting more renewable capacity additions from several low and medium income developing and emerging countries. Therefore, as we always say, the financing clean energy transition developing emerging countries of a crucial nature. Now, what are some disappointing news? If I have to pick up one of them, it is on the side of the green hydrogen or clean hydrogen. In other words, we at the IEA believe that hydrogen can and should play a very important role to address our climate challenge and also to diversify our energy mix. Of all the projects today in the pipeline announced with the current policies, current financing and construction level, only 7% of the project announced would see the light of the day, would come online before 2030. So the main problem here, as we see, is the creating demand for those projects and having the right regulation in order to give a stimulation for the consumption side. Again, we hope to see that the governments and the regulators take the necessary steps to create the demand, as we think hydrogen can play a very important role in our fight against climate change and for energy security and to diversify the energy mix.
Still on Energy Frontiers, Middle East tensions continue to push oil prices higher. We will be right back.
A very good morning and a warm welcome to the Africa Energy Week for 2023.
This is our chance to make a difference.
We want to breathe fresh air in darkness.
This is Energy Frontiers. Now, the global oil markets have seen major shakeups in the past few days due to escalating cross-border crisis in the Middle East, oil tanker hijack, shutdown of Libya's Sharara oil field, and shippers complaining of higher costs. As a result of these, crude oil prices surged as Brent crude futures gained 2.72% to $78.89 a barrel, and US West Texas Intermediate crude futures rose 3.15% to $73.62. Julien Mathonneire is the oil markets economist at Energy Intelligence, and he tells me what themes will dominate the global oil market this year. So let's dig right into it. What's your outlook for 2024, and what major trends do you see shaping the global oil and gas market?
So in a nutshell, we see oil demand dropping back to their historical sort of level, which is around 1 million barrels per day. As the post-COVID rebound ends and economic pressures take their toll everywhere. We still see some support a little bit for jet fuel, some post-pandemic air travel and LPG and naphtha for petrochemicals feedstock. We also see a strong non-OPEC supply plus still going on. It looks set to continue in 2024, driven by the US, by Brazil, by Guyana, a bit by Canada as well. So we expect 1.5 million barrels per day of growth from non-OPEC plus, including 1 million barrels per day of crude alone. And this combination should keep prices in the $75 to $85 per barrel range. And this leaves limited room for OPEC plus, the core OPEC group and their allies to unwind their cuts, the cuts they've done since October 2022. So I think the demand trajectory for oil will be key this year. As for gas market, this should remain finely balanced, but risks remain. We still got geopolitical turmoil. We've got potential unplanned supply disruption, stepped up demand. If it increases, it presents potential risk. Europe, after a full year of sharply lower Russian gas supply, has managed to find LNG elsewhere. Cargoes coming from Asia to rebuild storage. And it's been helped by, a relatively mild weather and good, good demand policy, limiting the demand for oil. Markets will keep watching whether Europe keeps attracting, squeezing out the remaining Russian supply and attracting more LNG from elsewhere, ramping up supply alternatives, notably from Norway, Azerbaijan, etc., a little bit from Qatar. So that's the outlook in a nutshell.
Right. So how much of an impact are the Middle East crisis, attacks on vessels, and Libya's supply complications having on these commodities? Put this into context for us.
Yes, of course. So I think, it seems to me that what matters is not so much sporadic events like, conflicts, wars or terrorist attacks, but longer term, geopolitical trends. Attacks against Israel-linked vessels in the Red Sea have continued, but you can see that Brent prices are struggling to retain their $4-5 per barrel price premium. What matters, however, is the rising fragmentation in commodity markets and the measures restricting trade in the long term. Some trade routes are becoming longer and suboptimal, which increase the cost of doing business. As the Red Sea events reminds us, prices are more volatile because adjustments are more frequent and they're more sudden, and commodity markets, as a result, are more fragmented. And as for supply disruptions in Libya, they followed the shutdown of the El Sharara oil field, and they essentially prompted refiners, especially in the Mediterranean, to secure alternative supply just in case lasts or just in case something more serious happens. So, they've been buying more US oil because it's very similar. I mean, it's sort of similar to Libyan oil. It's light and sweet. And they want to mitigate any potential and lasting Libyan crude export shortfall, And if Libyan disruption lasts, then it will probably make OPEC project to return more supply to the market even more difficult. They're going to struggle with that. We'll get to that in a minute.
And I hope we don't get to that point, because having to do a journey that used to be 2 days or less, and you have to do a turnaround in order to be able to deliver some of these oil productions, it can be very daunting. So What should be done to mitigate these headwinds to normalize supply and keep oil prices in the balance?
Well, our view of energy intelligence is that production capacity really is not a problem. In fact, OPEC is now faced with the opposite dilemma of having too much supply, too much of it. And you've got adequate spare capacity. We've got more than 5 million barrels per day into the system that can be used. A lot of it in Saudi Arabia, of course. We've got large inventories, oil inventories in China, which can serve to cap prices, to limit any price uptick, serious price uptick. And even if OPEC's forecast of 2.25 million barrels per day of growth demand in 2024 sort of is realized, then I think that still rules out a major tapering of OPEC's and especially Saudi Arabia's current cuts in a fair and orderly manner. Because, as I said, we expect 1.5 million barrels per day of additional supply from non-OPEC. So the question is, how does OPEC do to return more supply to the market? How can they reverse the cut? It's going to be very difficult, and it's going to be very tricky math, with the quotas from other members. I think it's the biggest hurdle for OPEC coming.
Yeah, to be some hurdle over there. So, how much of impact is Angola's exit? Speaking of OPEC, that is, how much of impact is Angola's exit from the OPEC alliance going to have on the country's oil production and exports to the international market?
Well, Angola has taken the decision to withdraw from OPEC after 17 years of membership. Angola has been underproducing by more than 300 barrels per day, 320,000 barrels per day exactly, owing to, major shortages in upstream investments, oil theft, aging infrastructure, etc. I don't think Angola's withdrawal from OPEC will change OPEC calculation a lot, since, they have consistently produced below their quota. In fact, I think what it means is that the underproduction from OPEC will probably improve in the coming month as a result of Angola's withdrawing, because they don't have to include the country in their calculation anymore. And as I said at the beginning, I think demand will be a key variable for OPEC supply strategy in 2024.
Finally, the most anticipated energy event of the year, the African Energy Week 2024, comes up on November 4th to 8th in Cape Town, South Africa. The event connects African and global energy industry heavyweights, presidents, ministers, investors, and policymakers to chart the course for a sustainable energy future. Registration for early bird delegate pass closes on January 31. To register your spot, kindly visit the AEC website on www.aecweek.com. And that's the package of Energy Frontiers at this time, and we thank you all for watching. Be sure to follow the program on Frontier Africa Report's website, like this video, subscribe to our YouTube, and follow us across all our social media handles as indicated on the screen. I am Justina Okechukwu, and I'll see you next time.